Welcome to the Deep Dive. Today, we're really getting into the weeds on Dentsply Sirona's Q2 2025 earnings call.
That's right. We'll be looking at the numbers, the big leadership changes, and what it all kind of means for where they're headed.
Exactly. Our goal here is to give you the key insights, maybe some of the less obvious points from that call, so you feel fully up to speed.
And maybe even a little ahead of the curve.
Hopefully. So let's kick things off with the market's take. How did investors react? Because honestly, looking at some numbers, it wasn't immediately obvious.
It was surprisingly positive, actually. The stock saw an immediate uptick. Yeah, there seemed to be this sense of confidence, almost like a relief, perhaps.
Interesting. So maybe looking past some of the current figures, let's lay out those headline numbers then. What did we see?
Okay, so adjusted EPS came in at $0.52. That was a slight beat against expectations.
Okay, positive start there.
And the adjusted EBITDA margin, that really jumped out. It expanded significantly to 21.1%. That's pretty strong, shows some real efficiency gains.
Right. But then you have the GAAP number.
Yeah, the GAAP EPS was actually a loss, came in at negative 0.22 cents. And that was largely due to a pretty hefty non-cash impairment charge. We should definitely circle back to that.
We will. And revenue.
Revenue was $936 million. Technically a slight beat, but still down year over year.
Okay, so top line still shrinking a bit.
And then there's the cash flow, which looked a bit concerning on the surface. Operating cash flow dropped quite a bit.
How much?
Down to $48 million. And adjusted free cash flow was only $16 million.
Wow, okay. That is low. So a really mixed bag overall.
Definitely mixed. But like you said, the market seemed to focus on the positive, particularly that margin expansion and the EPS beat.
It suggests maybe investors are buying into the future story rather than dwelling on, say, the cash flow dip or the revenue decline for this quarter.
I think that's exactly it. It's about efficiency, profitability, and maybe the new leadership narrative.
Speaking of which, that leadership transition felt like a huge theme on the call. Really signaling a new era, wouldn't you say?
Absolutely. It's a major shift. You've got Dan Scavilla stepping in as CEO, effective August 1st. This was his first earnings call at the helm.
And his background is quite operational, right? Globus Medical, J&J.
Exactly. Heavy focus on operational execution. Spinal vision care at J&J. He seems very focused on, the how getting things done efficiently. That message came through loud and clear.
And he's not alone. There's a new CFO, too.
Yep, Matt Garth. He started back on May 30th. And what's striking is how aligned their messaging is.
What are they emphasizing? It's
all about value accretive activities, improving the customer experience, driving those margins higher, and really disciplined capital allocation. Very focused, very operational.
A clear break from maybe past strategies.
Seems like it. And perhaps underlining this whole transition, Andrea Daly, the VP of Investor Relations, also announced she's leaving.
Right, so a real changing of the guard. Okay, with this new team setting the tone, let's dive deeper into those financials. Beyond the headlines, that impairment charge you mentioned, $214 million, unpack that for us.
Sure, so it's crucial to remember this is non-cash. Money isn't, flying out the door. It's an accounting adjustment.
Okay.
Think of it like this. Say you bought an asset expecting certain returns, but now, because of maybe new tariffs or lower demand for products related to that asset, you don't expect it to generate as much value. You have to write down its value on your books.
Got it. And which parts of the business did this hit?
Primarily their orthodontic and implant solutions, OIS, and the connected technology solutions, or CTS segments.
By those.
Directly linked to those ongoing tariff impacts, which seem to be a recurring headache for them, and also just lower volumes than they'd perhaps initially forecast when those assets were valued. It's a kind of reset.
A necessary, if painful, adjustment then. But despite that write-down, you highlighted the strong margin expansion. How do they manage that alongside falling revenue?
That's where the operational focus really shows. Adjusted EBITDA margin up 360 basis points to 21.1%. That's a big jump.
Huge. What drove it mainly?
The biggest factor was suspending sales of their Bite Clear aligner product. That was apparently a lower margin business, so exiting it helped lift the average.
Addition by subtraction.
Exactly. Plus, they emphasized lower operating expenses generally. And adjusted gross margin also ticked up by 60 basis points to 55.9%. So it's about being leaner, more profitable with the business they have.
Okay, profitability improving. But let's come back to that cash flow picture. Operating cash flow falling from $208 million last year to just $48 million. Adjusted free cash at only $16 million. That's stark. How concerning is that?
It definitely raises eyebrows, and it's something investors will watch very closely. Management did give specific reasons, framing them mostly as timing issues.
Such as?
Well, first, the timing of collecting cash from customers, basically receivables.
Okay, so money owed just came in slower this quarter.
Right. Second, they built up more inventory. Partly for their big ERP system implementation that always causes some temporary bumps, and partly to get ahead of those tariffs.
Pre-buying before costs go up further.
Potentially, yeah. And third, there was a comparison issue. Last year's Q2 included a $42 million foreign tax refund, which obviously didn't repeat.
Ah, okay, so that makes the year-over-year drop look even bigger.
Precisely. So while the numbers look bad, the explanation suggests it might not be a fundamental collapse in cash generation, more temporary factors. Time will tell, of course.
And to help with flexibility, they did that bond offering, right? $550 million.
Yes, a hybrid bond offering in Q2. They explicitly said it was to boost financial flexibility, which makes sense given the transition and the current cash flow dynamics.
Okay, so looking forward now, what's the guidance? Are they sticking to their plans despite the Q2 wobbles?
They are. They reaffirmed the full year 2025 guidance. Net sales still expected between $3.60 and $3.70 billion.
Okay.
And adjusted EPS forecast remains $1.80 to $2 per share.
So that's a signal of confidence from the new team that they can hit those targets despite the weak cash flow quarter.
It certainly suggests they see Q2's issues, particularly on cash flow, as manageable or temporary within the full year picture.
But they did flag something worsening, didn't they? The tariffs.
They did. The expected annual impact from tariffs is now forecast at $80 million. That's up significantly from the $50 million they previously estimated.
Ouch. That's a material increase.
It is. And they expect about $25 million of that hit to come in the second half of this year. So it's an ongoing and actually growing headwind they need to manage.
And what about the broader dental market? What are they seeing out there?
They said global patient volumes, sort of general dentistry, are largely stable, consistent with recent quarters.
Okay, so the base business is holding up.
Seems so. But, and this is key, the elective procedures, things like implants, orthodontics, they continue to see softness there, especially in the U.S.
Suggesting consumers are still cautious about bigger ticket dental work.
That seems to be the implication. Macroeconomic pressure potentially hitting discretionary spending.
How did that play out in the segment results?
Pretty much as you'd expect. Essential dental solutions, EDS think consumables, basic stuff, saw slight growth, stable demand there. But OIS orthodontics and implants and CTS connected technology solutions like scanners and equipment both saw significant declines year over year.
And the bite suspension hit OIS hard.
Yes, they said that accounted for over half the decline in OIS. So part of it was a deliberate exit, but the underlying implant market softness is real too.
Any bright spots in those struggling segments?
Within OIS, they did highlight growth in their SureSmile clear aligner platform, particularly strong in Europe and the rest of the world. So that digital ortho solution seems to be gaining traction, which is important for their strategy.
Okay, so putting it all together. Revenue down, GAAP loss due to impairment, weak cash flow, rising tariffs, soft elective market, yet the stock reacted positively. Why this disconnect?
I think it really comes down to two things. Belief in the new leadership and focus on the margin improvement story.
Explain that a bit more.
Well, context matters.
Yeah.
Before this report, Dentsply Sirona stock was down almost 28% year to date, massively underperforming.
Right, expectations were probably pretty low.
Exactly. So seeing that strong margin expansion, even with the other issues, and hearing a clear execution-focused plan from Scavilla and Garth, investors seem willing to bet on the turnaround. It's a vote of confidence in the potential under new management.
And this turnaround involves a pretty fundamental strategic pivot, doesn't it? Away from just buying growth.
Yes, that's the narrative. Moving away from an M&A heavy model towards being margin-centric, digital first, and intensely focused on operational execution.
So how do they actually achieve that? What's the playbook?
The key themes are disciplined execution, aggressive cost reduction, really looking at every part of the P&L, and crucially restoring strong cash flow generation.
Making those margin gains actually show up as cash in the bank.
Precisely. It's not just about looking profitable on paper. It's about generating the cash to reinvest, pay down debt, and potentially return to shareholders down the line. It's about profitable, sustainable growth.
And the digital piece, how central is that?
Very central. Their DS Core platform is key here. They mentioned hitting 50,000 unique users.
What does DS Core actually do?
Think of it as the central hub connecting their digital equipment scanners, mills, imaging, and software. It enables integrated workflows for dentists. It's the foundation for what they call proceduralization.
Selling solutions, not just products.
Exactly. Making complex procedures like implants or orthodontics smoother and more integrated for the dentist. That platform is critical for driving loyalty and future innovation.
Okay, it sounds like a solid plan, but definitely challenging. What are the biggest hurdles they face in making this pivot successful?
Number one has to be reigniting growth in the U.S., especially in those higher value CTS and OIS segments where the softness is most pronounced. Scavilla said they started working on that in his first week. It's clearly top priority.
Okay, tackle the U.S. market weakness. What else?
Second, converting those margin improvements into consistent, robust free cash flow. That's the real acid test. The market needs to see the cash generation improve significantly to fully buy into the turnaround.
Prove the operational gains are real and sustainable.
Cash is king. And third, they still have those external pressures. The increased tariff impact needs careful management, and there are existing securities investigations lingering, which always adds a layer of uncertainty.
Right, those external factors can always complicate things. So, looking ahead, what should we watch for? What are the potential catalysts that could really get investors excited again?
Well, the Q3 results and guidance update will be absolutely critical. Will they show progress on cash flow? Can they maintain margins? That's huge.
Any other signs of progress?
Definitely looking for more evidence of return on investment from DS Core and SureSmile. Are user numbers translating into revenue? Are dentists adopting these digital workflows more deeply?
Tangible results from the digital strategy.
Yes, and things like stabilization of the supply chain would help smooth operations. But fundamentally, it comes back to cash flow improvement, effectively managing those tariffs, and proving the digital strategy is working. That's what could really move the needle for the stock.
All right, let's shift gears slightly. Welcome to our wild yet plausible trade idea segment. Given everything we've discussed about Dentsply Sirona, the new team, the operational focus, the challenges, the potential, what kind of thinking might be out there?
Okay, so we're dubbing this one the Phoenix from the dental pulp arbitrage play. Tickers XRAY, of course.
Intriguing name. Lay it out for us.
So the potential long side of this conceptual trade involves Dentsply Sirona common stock itself, perhaps even with some leverage, hypothetically speaking.
Okay, why long XRA?
The rationale is that the market might still be undervaluing the potential for this execution-focused turnaround under Scavilla and Garth, focusing too much on the rearview mirror, the recent cash flow dip, the revenue softness.
Believing the new management can actually unlock value that's currently overlooked.
Exactly. And that $550 million bond offering gives them the financial runway to execute this pivot. It's essentially a bet on competent management turning things around, leading to a stock re-rating.
Okay, that's the long... What's the other side of this arbitrage, the wilder part?
This is where it gets more speculative. Imagine, conceptually, a short position, not on Dentsply directly, but on a basket of other dental tech players. Specifically, those trading at much higher multiples may be perceived as growth at any cost companies.
Companies without Dentsply's installed base or integrated approach.
Precisely. Companies perhaps focused on niche products or less comprehensive workflows. The thesis here is multifaceted. One, as Dentsply streamlines and becomes more efficient, they could actually start taking market share strategically.
Okay.
And two, if the broader market environment stays challenging, investors might pivot away from valuing just top-line growth and start prioritizing profitable, cash-generative businesses like Dentsply aims to become again.
So the short leg is a bet against pure growth stories and for a market shift towards profitability.
You got it. The overall idea is that Dentsply isn't just fixing itself, it's potentially repositioning to dominate this proceduralization trend as a leaner, cash-generating force. The short basket acts as a potential hedge, but also amplifies the return if Dentsply succeeds, and the market reevaluates those high flyers. It's a play on relative value and execution.
Definitely wild, but I can see the plausible logic behind it. Okay, let's wrap up our deep dive on Dentsply Sirona's Q2.
Sounds good.
So the key takeaway really seems to be a company in deep transition. New leadership, a clear pivot towards operational efficiency, margin expansion showing early promise.
But facing undeniable headwinds. Revenue pressure, that concerning cash flow dip in Q2, rising tariffs, and softness in key elective markets.
It's really a story about execution from here on out. Because the new team deliver on their promises, especially turning those margin gains into real cash.
That's the billion-dollar question, isn't it? Their digital strategy with DS Core and SureSmile is central, but they need to navigate the market challenges carefully.
Absolutely. Now, just a reminder for everyone listening, This conversation was purely for informational and entertainment purposes.
That's right. Nothing we've discussed should be taken as financial advice. Investing carries significant risks.
Always do your own research and consult with a qualified financial professional before making any investment decisions.
Absolutely critical.
Well, thank you for joining us on this deep dive into Dentsply Sirona. We hope you found it insightful.
Yeah, hope it was useful.
Let us know your thoughts, and we look forward to catching you on the next one, where we'll unpack another key earnings call.